Good morning, traders, and welcome to the weekend update and market outlook here for November 23rd, 2025. Now, it was a wild week here this last week, specifically if you come and look at the S&P and, of course, the Qs. If we zoom in a little bit here, we can see that we had a rather dramatic gap up. This was after NVIDIA earnings, and then a pretty significant sell-off through the course of that day. We gapped all the way up here to almost 6,800, not quite. By the end of the day, we're down here to almost 6,500. That is a massive swing during the course of a day, a 300-point swing in the S&P. So not only was it a big swing, but we also broke down below some lower lows. So that had been a prior low that came down to about this low. We did end up breaking through those just a little bit. So that's a little bit concerning. What was helpful was that on that down day, our volume was not significantly higher. And then the following day, when we had a little bit of an up move, not much of an up move, but on Friday, when we had that little bit of a bounce, if you will, volume was a little bit higher there. So that can be a little bit of a bullish-sided signal. But overall, we've definitely been a little bit of a downtrend here recently, making lower highs and lower lows. And I would also say that this formation we're seeing here is a rather typical head and shoulders pattern. Head and shoulders patterns will often signify a move lower as well. So what I'm looking at really is we need to see this 6,500 range hold over the next week or so. If that does not, to me, it's not at all out of the question that we're coming back down to around 6,300 or so. Now, given the move that our markets have made so far this year, yeah, you don't want to see that, but at the same time, it's somewhat standard for markets to do what's called backing and filling. Sometimes they just get a little bit ahead of themselves. They need to consolidate, maybe even chop sideways a little bit, and then they can go on and resume their rally. That doesn't mean there's anything technically wrong. It just means that it's run a very hard sprint here. It needs to slow down a little bit, possibly even walk a little bit, catch its breath, and then maybe start making the next move. So that's what we're seeing here in SPX. Take a look at SPY. It's going to look exactly the same. Of course, SPY is just 1/10. That is the ETF. We can see on SPY here, though, we have an opposite effect. We have a much higher volume on that down day than we had on the up day. So why that divergence? Why that difference? Let's think about who trades what products. So generally speaking, SPX is a larger product. It's more going to be traded by institutions, by the big money that's out there. Who tends to trade SPY more than anyone else? That tends to be traded by retail investors, by what I'll call amateurs. That doesn't mean that amateurs aren't sharp. It just means it's a different group of people that many times a different take on the market. And the retail traders were a little more spooked by that move than the large institutions were. We also come in, we can look at ES. ES is traded by both. I would say there's lots of retail traders, of course, that trade the S&P futures known as the ES. There's lots of institutions that trade those as well. And you can see that this is almost an average of those other two. Overall, we did see a little bit of an uptick in the volume in S&P futures on the down day across the three main products that the S&P futures get traded on. Now let's look and see what volatility in that area did. Volatility spiked up, but as we can see, volatility in the past has spiked up right into around that 28 range. That's where it spiked to this time, did not break through it. So right now, I still feel like volatility is telling us that there's not a significant fear in the market. If we crack that 6,500, I think we're going to see a different story here. I think we probably will see volatility spike up maybe into the mid-30s or so. So that's something to keep an eye on this week. This week, of course, being a short week here in the U.S. because of the Thanksgiving holiday. If we look at the Qs, we see a little bit of a similar story in the Qs. We see that we definitely had some higher volume on that bigger down day. We also can see that similar looking head and shoulders type top that seems to be forming. And in the Qs, I would say we're probably looking to have this 580 hold somewhere in that general vicinity. If that 580 does not hold, I think it's pretty realistic that we're looking down here around that 550, 540 range as a next likely stalling point, if you will. Let's look at volatility and the Qs. And volatility in the Qs did pick up a little bit higher here than some of the prior highs. Qs a little more volatile, people buying insurance a little bit more on the Qs. That drives up those options prices, which gives us a higher VIX reading. So we need to recognize that for what it is. And of course, the Qs or the Nasdaq, the tech stocks, are driving the bus with our markets for sure at this stage of the game. If we look at IWM, as I said last week, IWM did appear to be weakening, and it continues weakening here a little bit. It continues on its current downtrend. It did break through this particular area, rebounded above it again on Friday, but it's probably, in my opinion, looking weaker than the other two, and it has a little bit of ability to maybe put some drag on those other two as well. So if IWM were to break down a little bit further, I think a logical stall point on IWM might be around that 220-ish range or so, if that were to continue down further. And let's look at the volatility on IWM. Started hitting kind of some of these same highs that had been being hit previously, right around that 30 mark. Haven't really broken to newer highs in volatility, but if that continues going down, I think that's certainly a possibility as well. And then on gold. So gold, as I had mentioned after this huge run, this is what I might expect to see out of the S&P, maybe out of the Qs, a little bit of a backup, backing and filling, then a little bit of a chop sideways, taking that breather after it's run a sprint, and then maybe getting ready for the next leg of the sprint, possibly after Christmas. There's often what's called a Santa Claus rally, which is right around Christmas time and into the end of the year. This year, we've already run really hard most of the year, so I don't know if Santa's got enough left in him to make that last little push, but more often than not, there is that push going into the very end of the year. So those are some of my outlook on what's happening with our market right now. I am not bearish per se. I'm also not bullish right now. I am leaning into the camp of little bit of a down move, little bit of a chop sideways, probably across the SPX. So I think we're just seeing that pull back, consolidate a little bit sideways. Now, many of you have seen a trade that I've been trading called the Flyagonal. It's a trade that I designed and developed over about a year of work using some AI technology to help me refine it a bit. And then I started trading it live in May. That trade has done extremely well. That trade has had, I believe it's 120 some winners now, 7 losers, over 150% return in 6 months. If you want to see a little bit more about that, watch this next video, and I'm going to share a few things on that to give you a better look at how that works and why I think it's been such an excellent trade over the last 6 to 8 months that I've traded it. Take care, everyone.